Hello, everyone, and thank you all for joining us today. Welcome to this fun deep dive live where we'll be discussing the Simplify Currency Strategy ETF. That's ticker FOXY, one of my favorites. FOXY is a truly innovative offering. Nobody else is attempting to harness the potential of currencies the way that we are here at Simplify in an ETF vehicle. And we're so excited to discuss it with you today. But before I get too far ahead of myself, I should point out that today's discussion is for educational purposes only. With that in mind, to make this as useful as possible for you, we welcome questions and invite you to submit them through the Q&A function at the bottom of your screen. My name is Chris Getter, and I am a portfolio manager and strategist here at Simplify. Joining me today, someone whom I've now had twice the pleasure of calling my colleague, is Ken Miller. Ken, would you mind introducing yourself to the audience?
Sure, Chris, thanks. It's nice to be able to work here with many of my former colleagues who are experienced market professionals. And over my career, I've been able to build knowledge of many different asset classes. As Chris mentioned, most of my experience has been in currencies and global bond markets, having spent 22 years at PIMCO and now with Simplify, which I joined after its founding in 2021. I work on a number of our strategies here, including hedged equity, managed futures, the commodities product, and our fixed income funds.
Got it. So you've had a long career working in this, I guess we should call it asset class. But can we break that down a bit? I mean, most of our audience has experience trading ETFs, stocks, maybe even individual bonds, and they see them moving around every day. But I reckon a small subset of our viewers has experience in the currency market. So maybe we can just kind of level set a bit in terms of what managing currencies means.
Definitely, I'll start high level, and then we can drill down as deep as you want to. The first thing I would note is that just like commodities, the FX market is populated by two different types of participants. The first would be the actual users and holders of foreign currency. That would be companies with revenues or liabilities that are exchanged in another country, and they are primarily focused on hedging or reducing their currency exposure. Their goal is basically to not lose money. And secondly, you have what are called speculators, and that includes us at Simplify and anyone who is investing in currency for profit, just as you hear them referred to in commodities as speculators.
And this is a huge market, right? I mean, the most recent numbers we have are that volumes are somewhere in the $7.5 trillion per day range. So the presence of different investor types with very different objectives makes this a very liquid market.
Yes, a very large market, very liquid market. It's generally below the kind of the visibility of many investors. Might seem inaccessible to many investors who don't regularly invest in the global markets. But one thing that investors should know is that this, when you invest in currency, it's not simply about converting your cash US dollars into another currency and saying, now I'm holding euro, yen, or Mexican peso. The vast majority of the transactions, particularly for speculators like ourselves, is done in what's called the forward market, where we agree to a rate at which we'll exchange the currency in the future. And that future exchange rate is what we call the forward rate.
Got it. And again, not to keep coming back to the commodities market, but in terms of instruments, these forwards are a lot like the futures that folks might be more familiar with, but with a few differences. First, they are bilateral. They're not centrally cleared. So your counterparty is a global bank rather than a clearinghouse on the other side of the trade. Second, they offer a lot more flexibility in terms of tenor, size, and pricing, right?
Yep, and another important difference is that because foreign exchange is actually a relatively low volatility asset, certainly with respect to equities and commodities, the margin requirements in foreign exchange tend to be lower than other assets. Initial margins are zero or small, and typically you're only posting variation margin.
Got it. True. So let's come back to that in a bit because I think that concept is going to make more sense in the context of how FOXY is constructed. One more thing we should spend a moment on is this concept of how you make money in the FX market, or maybe putting that differently, like Why should investors care about this market and ultimately about FOXY?
Okay,
Those
sure.
of
Yeah.
us, and just
Yeah, go ahead.
just to be more specific, like those of us who work with currencies, we throw around this term implied yield as a measure of what a currency like pays you, and might be helpful to explain what that means.
Definitely. Well, we can start with an economic concept that many of us are probably familiar with, and that's the law of one price that states that the prices of goods in one country should be the same as in another country. Relatively speaking, a Big Mac in one country should cost the same after adjusting for currency. We know that that's not the case, but that's the thought behind the law of one price. We can extend that law of one price to interest rates. And when we extend that, we can say that the difference in interest rates between two countries should be the same as the expected change in the exchange rates between them. And in a fund like Foxy, we would make money. We try to make money by effectively betting against this relationship.
Got it. Only when we do this, it's no longer called the law of one price. It's known as interest rate parity. And the way that I like to think about it is that your indifference between holding one currency or another is achieved by either a movement in the exchange rate or by earning a different yield between the two. And we've put together a little bit of an example here to help explain.
Yes. So I'll go through this. So on the left-hand side, if you look in the box with the flags, uh, you can, as a U.S. investor, you can put your risk-free money into a U.S. T-bill, earn about 4%, or you can agree today to buy the Mexican peso in 1 year at a rate of 21 and a half pesos per dollar versus its current spot value of 20 and a half pesos per dollar. And if we transact this forward, if we go short the dollar and long the Mexican peso by buying the 1 year forward, and over the course of the year, the spot exchange rate in Mexican peso fluctuates, but eventually does not change over that year when it ends up. We would earn that 1 point of appreciation when it moves from 21.5 to 20.5. The peso is appreciating versus the dollar.
Got it. And that 1 point discount that we've locked in, that equates to the implied 4.7% weakening in the peso shown in that center box, right?
Yes, exactly. But that brings us back to kind of what you had originally asked about on the slide is the implied yield. If I lock in a forward exchange rate and I know what I earn here in the US, be it bills or some other risk-free rate, then I can compute a yield, an implied yield that I would earn if I were holding the peso. And we don't actually observe that directly in the market, so it's termed as an implied yield.
Got it. And as we've noted, this is the rate at which you would be, again, like indifferent between holding dollars or pesos.
That's right. But a lot can happen in a year. We're living through a trade war right now. And if we are long the peso, where the peso in 1 year's time determines the spot rate of the peso in 1 year's time will determine how much of that implied yield translates into return.
Got it. So I feel like we've been doing a little bit of like hypothetical here. Let's look at that table on the right. So if this just shows the peso appreciating, the lower numbers, or depreciating, the higher numbers in that first column, and then it shows what you would earn from the component. So if FX appreciates, you have been long the peso at 21 and a half. If it goes down to 19 and a half, 18 and a half, you make money from the FX. You earn whatever your bill rate was in the US, and you have the total return on the right-hand side. If it depreciates, goes the other way, you end up losing a bit on the FX, you still earn the US rate, and then your return could be negative depending on how far it moves, looking at that right-hand column.
Yep, and what I like to think of many people like to think of the implied yield as a break-even protection against a weakening spot exchange rate. In this example, it looks like the point where you'd have a zero return would be somewhere between 21 and a half, 22 and a half, and that relates to, you had earned interest on your T-bills that gives you a little bit more protection beyond the 21.5 level.
Got it. I feel like we've been doing a little bit of like Forex 101 here, Ken, maybe too much. Let's shift gears and talk about FOXY. We've had a lot of conversations with clients about it already, and I have found it helpful to start off by telling them what FOXY is not. It's not making a bet on currency movement. It's not saying Simplify thinks this exchange rate is cheap and we're going long, or this exchange rate is overvalued or expensive and we're going short. In other words, it's not a directional view on currencies that we're expressing here.
Yes, Chris, that's what you've described as the fundamental approach to currency investing, where you observe many, many different macroeconomic variables, the monetary policy of a country, its growth rate, its inflation rate, its fiscal and trade balance, and any other foreign cross-border investment flows. And your goal is to come up with a view on, over a time period, over a time frame, what the appropriate level of the currency would be. And we would, I think, most people would acknowledge that that's an extremely hard investment to get right. You may have the right call, but frequently the timing is wrong. And for the case of FOXY, we're not doing that. Our broad kind of approach is we can, or the general concept behind FOXY is that we can systematically harvest these implied yields we spoke about based on the way that we know that the currency market, we feel that the currency market behaves. So yes, you're 100% correct. FOXY is not taking a view on how currencies will move.
Got it. And when you say the way the currency market moves, this is largely based on observations over the course of market cycles, right? We've looked at this for a long time.
Yes, I've looked at currencies and traded them for a long time in my past experience. And the one thing that I've observed and I feel very confident about, and I think would be agreed upon with many, is that G10 currencies behave differently than emerging market currencies, and that if you try to apply a systematic approach to both of them at the same time in the same way, it's suboptimal. And you need to acknowledge that there are differences between the way the developed market FX works versus emerging.
Can you expand on what those differences are, and maybe just share a bit of your insight on why those differences exist?
Sure. In developed markets, the moniker for that is G10. Economic activity has evolved, since the advent of the euro in 1999. Economic growth, inflation rates have converged and are much more synchronized. You will see variation in levels of GDP growth of countries. And for example, let's take recent quarters. Spain has been growing at above a 3% rate, while Japan has been just marginally positive. But the direction, not the magnitude, but the direction have tended to be the same. And that tends to lead to more synchronicity in monetary policy cycles. And that's very different from emerging markets, where you have tremendous dispersion across regions, within regions. It's dispersion in growth, inflation, monetary policy, political bias, Argentina versus Brazil, let's say, and level of debt, current account balances, et cetera.
Yeah, Ken, I grew up in EM. The term that I use is that emerging market countries are a lot more heterogeneous. But what are the implications of this split between G10 and EM for currency investors?
Yeah, so basically the kind of the rule that you want to keep in your mind is that G10 currencies will mean revert. That is, they will not trend too long in one direction before they come back to a mean point. And emerging market currencies tend to trend. And I think we have a slide that I will reference. But what we have here is 3 different style indexes, and investors in equities that are style investors will know the difference. Have heard of carry or yield, dividend yield, let's say, value and trend. Momentum is the other word for trend. What you can see over time, and this is back from 2007, the blue line is the carry index, and that has worked very well over long periods, but it is susceptible to some significant drawdowns. Value, which is in the gold line, has competed pretty closely with carry, and you can see if you look back to like 2015, you'll see that when carry was underperforming in the middle of the chart, value was outperforming. So they do tend to complement each other. But one thing that we can clearly say by looking at the orange line, which is the trend / momentum, is that it has struggled to produce consistent returns. And another thing we've observed is that an implied yield approach in the G10, as opposed to a pure yield, a level of yield approach, has shown the ability to act as a stabilizer and can cushion the downturn in risk assets such as EM. And we witnessed that most recently in the 2020 pandemic.
Got it. One other thing we should clarify, we've been pretty selective about the opportunity set here, especially when it comes to EM. Yes, I mean, we've exercised a fair amount of discretion based on your long experience in the market, based on our evaluation of liquidity, transactability, transaction costs. And we focused on markets which we think are appropriate for a strategy like FOXY. I mean, we're not like dumping every available currency in and seeing what comes out the other side. But speaking of what comes out the other side.
Sure. So once we have universes of emerging market and G10 currencies that are ranked in the emerging market currencies by the level of yield, in the G10 or developed market currencies are ranked by the momentum of implied yield. And based on that output, we select currencies to go long and currencies to go short. In emerging markets, it's 4 long and 4 short. And in the G10, it's 3 long currencies and 3 short currencies. And the weights of the currencies in each of those longs and short, which comprise the basket, are optimized by weightings. We use a weighting that minimizes the volatility for emerging markets, because naturally that's the more volatile of the two classes, and then a measure that looks at the risk-adjusted yield for the G10, like a backward-looking risk-adjusted yield.
Got it. Ken, when it comes to how we weight the positions, I want to link up to something that you mentioned a few minutes ago, and that's this notion that the forward contracts have more flexible margin requirements than say futures. FOXY uses that to our advantage here because we're scaling the longs and shorts up with a volatility target of 15%. The symmetry between the two sides is also consistent with what we said earlier about not expressing directional view on the dollars. But what does that mean in terms of the overall exposure? And secondarily, what drives the split between the EM and the G10 currencies?
Chris, I'm glad you mentioned the not expressing a directional view on the US dollar. That is a critical piece of FOXY. It is net dollar neutral. It is not expressing a view the dollar index is going to go up or down. The weights of the currencies on the long side and the short side, if you add them up, sum to 0. And they're weighted dynamically. We rebalance, right, over different frequencies. We rebalance weekly in emerging markets and as frequently as daily in the G10. But the way we weight them is that they make roughly equal contributions to the overall volatility of the fund at its master level. And the emphasis is on minimizing the overall volatility. If we were to take the signals and apply them historically, we would see a portfolio with a volatility of about a 5 to 6% in that range. The goal of FOXY was to build something that investors would consider to be an alternative type investment with more yield and return potential. So what we've been able to do is scale the positioning up to about a 15% target volatility. And I guess I'll ask you, Chris, like, is that how do clients look at it?
Well, first, I just want to reiterate that resultant notionals of like 300%. That's 300 long and 300 short. So it preserves that non-directionality with respect to the dollar. But yes, if when I look at our product lineup here at Simplify, we've got a continuum of strategy types. At one end, you have straightforward like stock picking funds like Pink, our amazing healthcare ETF, or IOPP, our similarly amazing India fund. Those are our individual security selection strategies. At the other end, got something like QIS, our quantitative investment strategies ETF. It doesn't get much more alternative than that in terms of the different performance levers the fund can pull. I think FOXY is kind of in the middle. It's that first step into the alternative fund or alternative exposure space. Yes, the aim is to produce attractive returns, which have minimal correlations with traditional betas like stocks and bonds, but the mandate is pretty well defined in the currency space. So I think it's kind of in that getting to that 15% volatility target with a one Sharpe ratio is very much in line with what we wanted to deliver and what we're hearing demand for from clients. But speaking of attractive returns, what should investors expect from FOXY?
Well, I definitely won't make any predictions or anything that would indicate what I project, but what we can talk about is the mechanics and the structure of the portfolio. And we know because of the minimal margin that you mentioned, when coupled with the forward contracts and the currency, FOXY holds 100%, basically 100% of its hard assets in U.S. Treasury bills. And we do intend to distribute the income from bills on a quarterly basis. And then on top of that, investors have the benefit of investing in the currency forwards, which will have the potential to earn roughly the weighted average of those implied yields that we spoke about. Now, whether or not the spot moves, offsets that is another factor.
Yeah, and it's worth noting that the average implied yield is probably a cap in terms of what the currency positions will contribute to return. I mean, if currencies depreciate by more than what is priced in the forward, it will be eating into that implied yield. And I think the term you used a moment ago, Ken, was break-even protection.
Yes, I mean, I'm an old bond guy, right? So I got to be cautious. And the forward price at which we transact I think of it like a cushion that I have that the peso can, or any given currency can weaken beyond, up to that point, and I will still make money. And then if it goes beyond that, I lose money.
Yeah, I like to think of us as young bond guys, Ken. So it might be unwise to talk about losing money during a fun deep dive live like this. But since you are bringing that up, let me ask you, Ken, what can go wrong for FOXY? Or maybe another way to ask that question, when is FOXY's strategy not going to work?
Whenever you have a systematic strategy like FOXY is, it's susceptible to the model just, breaking, right? Like it would have to be what you think we should think of the strategy behind FOXY as a little bit of a codification of our understanding of the way that the FX market trades, its reactions over many different economic conditions and scenarios and different cycles. And if my experience and by extension the modeling of FOXY are no longer a reliable guide as to how best harvest yield from currencies, and then that's going to be a headwind. The other thing that we could have is if we see a break in something that a world order in the global financial markets and a currency policy regime. The most common one that we think about is the fixed and the narrow exchange rate bands that you see in Asia. That have characterized the last 25 years. If were those to suddenly radically break, that would present some challenges.
So, geez, I don't want to end on such a downer, so I'm going to add a couple of things. First, at Simplify, we do not equate systematic with immutable. A good model incorporates the manager's discretion at the front end. in how we specify it. And it should account for new information. It should consider new factors. It should ignore old factors that have become perhaps less relevant. It should reweight them as needed, still being systematic, but again, tweaking on the model construction rather than second guessing the model output. Second, I want to bring up another slide here, which is even under the current specifications, this is a highly active strategy where, as Ken talked about, the positioning is scaled based on volatility. And you can see across the 16 currencies that we've held in the just over a month since the ETF launched, 5 of them have been held on both the long side and the short side with some pretty dynamic movements in sizing. So the short-term response to an environment like you've described is likely to be a reduction of risk-taking, which affords some, I'm not going to say protection, but some cushion.
100% right, Chris. And I guess at this point, if you have any questions about any of the slides or any other questions that the audience has, we would love to address them.
All right, so I got one question here. I'll direct it to you, Ken, since you're better qualified to answer it. You'll give a nicer answer than I will. With all the uncertainty, I guess maybe you'd even say antagonism between the rest of the G10 and the US, how do you handicap, just fundamentally, how do you handicap the probability that we are in that new world order you talked about earlier?
Well, yes, there are the tariffs that have been threatened, right, on the 3 major trading partners, Canada, Mexico, and China, and then with respect to some on forthcoming on Europe. I think those are starting points of, and they're intended to provoke a shift in onshoring, manufacturing, et cetera, back to the U.S. I don't think that I've heard anything yet from the administration that would signal that this is a radical reorientation of currency policy, which Treasury Secretary Bessent has reiterated his support for the strong dollar. So haven't heard that yet. Tariffs are a negotiating tactic. They may come to fruition, but I don't think we're at the point where a major break in that world order is pending. If anything, we're moving towards hopefully a peaceful resolution in the Russia-Ukraine conflict and in the Middle East.
Got it. A couple of good ones coming in as well. So this one I'm going to answer because I'm not entirely sure I would agree. Question is, you look like you had some unusual EM currencies. That's the premise. What are they and how are they chosen and changed? I'll answer first, Ken, then I'll turn it over to you. The EM currencies that are in the basket, I alluded to this before with respect to liquidity, transaction costs, et cetera. Those are some of the larger FX markets. We could stick up a long list of EM currencies, most of which I probably wouldn't recognize the tickers for. I would challenge Ken to recognize the tickers for. But these, in my experience, these tend to be pretty plain vanilla EM currencies here. What would you add to that, Ken?
Yes, I would say that many investors that come to invest that just start to become familiar with emerging markets are really shocked and excited about seeing a country like Turkey, with a 30 to 40% implied yield. But the fact is that many of those currencies that have those, even the Russian ruble, for example, they're almost inaccessible to banks. Just won't underwrite risk on them. And so to answer the question about how did you choose and the basket of currencies, it's the most, if you go to the BIS 2022, I think it's the most recent report, we looked at the currencies both in emerging, and G10 is not really a factor, they're all liquid, but the emerging market currencies that are the most liquid, that was a big factor in our selection set decision.
So just to summarize, fairly pedestrian in air quotes set of currencies in EM.
for sure.
Got it. Okay. Two more I've got in the queue here. Do you expect FOXY to perform like a risk asset? In other words, would a severe risk-off event, GFC, COVID, would that be good, bad, or neutral for FOXY?
Well, so it's got a big, big, when I say big, the EM weight versus the G10 weight fluctuates. It's not necessarily equally weighted. It's not necessarily 50-50. It can be 40-60 or 60-40. So yes, it's got having the high implied, being long the high yield currencies and short the low yield currencies is definitely a risk on posture for that component of the portfolio. However, the implied yield when you move to the G10 and you think of the portfolio in its full context, the G10 component, the implied yield measures that we evaluate, give the overall portfolio a bit of a stabilizing type of an effect, where implied yields are a little bit of, you can almost think of them as analogous to a relative strength index, an RSI, for those of you who follow technicals in FX. I think of them that way, and it's debatable whether or not others do. But the when something gets oversold or overbought in the G10, that implied yield goes up if it's oversold, and we would try to buy that, and that dampening power in the G10 will help. I shouldn't say will. It has shown the ability to help offset risk-off episodes that you would experience in EM.
Got it. Got it. I'm told we can answer this question, but I would answer with a range. What is today's portfolio implied yield, and what range do you expect over time?
So I'll let you. I'll just lay out some of the indicatives that we see in the market. So, the long currencies that Chris showed on that bar slide, that the slide with the where the EM was on the right hand side, those yields range from like 9 to 11%. The short yields, the renminbi, the Korean won, those range from 2 to 4%. So 10 minus 3 is 7%, right? So now I'm not making any predictions about the implied yield of FOXY. I'm just the starting point. Then that's probably 50% approximately of your portfolio. So that goes to 3.5%, call it. The G10 yield difference is really negligible, because you're not in a position, you may be long the low yielding currency and vice versa. So let's just take the 3.5% for a one-time portfolio. And if you take that up 3 times, that's 11. That would be 11% just on average, right? Now that's in addition to whatever yield you earn on your bills, just like in that example we showed in the investment. So I won't specifically say, but that gives you an idea. And these are observable market levels of yield that you can see, and you could see it in our portfolio as well.
Cool. Thank you. One more we've got here. At our peril, how should investors source assets to invest in FOXY? Should it replace a portion of fixed income allocation or an equity allocation? I'm going to answer, it depends, which sounds like kind of a cop-out answer, but I'll just share my thinking on this, which is it depends on your initial condition. So if you are an investor who's got you've moved from 60-40 to, let's say, 50-40-10, 50 equities, 40 bonds, 10 alternatives, and right now you've got one alternative investment, then I think it makes sense to diversify within your alternatives bucket. You can decide what level of diversification that means, but going from one asset to two asset might suggest something. But that's how I think about it, which is, it should be part of a well-diversified alternatives exposure, rather than just saying, I'm taking out of my equities or my fixed income specifically.
We do have a question that I don't know if anyone wanted to add anything to what Chris said, but we do have a question that asked about why is no one else doing this particular strategy. Others are doing this strategy, but they're probably going to be in hedge funds and private vehicles. I've not found an ETF that is doing this. Now, a lot of times you don't know the specific approach, systematic or fundamental, that the hedge fund is applying, and it may be that it's quite similar actually, but there's no way to observe it. If it's not in a liquid vehicle that we have no access to.
Right. Yeah. I mean, the only thing I will say is emphatically, yes, no one else is doing this. At least as Ken said, in the ETF space or publicly available space. What we have found are if you investor have a view on the dollar, either positively or negatively, there are vehicles you can go out there and use. I have no quarrel with how those are constructed or the thesis underpinning them. But that goes back to Ken's point. Like, if you're making a directional currency bet, you have to get the timing right as well as the call right. So even if you figure out the dollar's wildly overvalued, back up 2 months and you thought Dixie was super expensive and you wanted to take a bearish view on the dollar, you would have been right. But when would you have been right? Like, had you put the trade on at the exact right time? So as Ken said, there's plenty of people probably doing parts of this. Maybe they're doing parts of this in hedge funds, or maybe a hedge fund is using this as part of a multi-strategy approach. But so far as we're aware, there's nothing like this in the space. And then one last question, Ken, I think you alluded to this before in terms of what we're doing with the cash, given how the portfolio is constructed. What kind of cash cushion is required in your hands given daily liquidity?
Well, so we have we talked a little bit about the volatility that we were targeting. So 15% annual vol, right? So, and we can, or sometimes we have to commit initial margin with, to post margin with our banks, but sometimes we don't. And that, since we're holding T-bills, you're basically in cash. So it's, if the portfolio depreciates, the entire portfolio depreciates such that, the bank wants to increase your variation margin, then it's easy to liquidate the bill or transfer the bill, right? So I would say that we're already at 100% cash or 100% bills. So there's not an issue with meeting both margin calls and daily liquidity from redemptions.
Got it. We're just about out of time here. For everyone who spent a portion of your day with us, we appreciate your time. And Ken, thank you for sharing your perspectives on the currency market, for educating us a bit, and most importantly, for sharing your thoughts on how FOXY might be of use to our clients in their portfolios. All of us here at Simplify are beyond excited about the addition of FOXY to our lineup, Ken and I in particular. And if you have questions, if there's anything we weren't clear on, if you want to learn more, I encourage you to reach out to any of us here at Simplify, and we would be more than happy to help. Thanks again to you all. And before we sign off, heads up, we will not have a Fund Deep Dive live next month, as we're having our quarterly market and strategy update, which will feature Mike Green, Paisley Nardini, and Jason England. The next Fund Deep Dive live will occur on May 22nd, where Jeff Schwarty and Sid Sethi will be discussing Simplify's 2 new barrier funds. Cheers, everyone. Thanks again.
Thank you.